Hello everyone, welcome to the 154th episode of me learning how to trade in Forex. So in the last episode we went through what kind of trader are you. So basically before you choose which products to trade or invest in, you need to determine what kind of trader you are, as some products are better suited to you than others. So there's many different types of trading and investing. Finding the one that works for you makes the most sense and fits your particular risk profile is a decision that can't be rushed. So then there's questions to help you determine what kind of trader you are and which financial product is right for you. So we've got how much time you have, so whether you're suited for long-term investing or short-term trading. Which trading style best suits you, so we've got which type of trader are you. We've got day trader, scalper, swing trader, momentum trader and position trader. And then we went through what each of them are. So, position traders. And then we got how much capital do you have. So to get started as a trader, you may need to have a fair amount of free capital at your disposal. And then we got a risk versus reward chart. So the more risk you take, the higher the reward is going to be. And then we've got drawdown. Basically, drawdowns when you have a string of losing trades or investments that dent your capital. So this will inevitably happen to you at some point in the future, and you just need to be prepared for it. So and then if you're comfortable with the idea of losing so much of your capital, you may want to focus on your long-term investments instead. So you can also practice your trading strategies with our demo account, or not their demo account, but any demo accounts, until you feel comfortable and confident. Cool. And then we went through the lesson summary. So now we're on to how to work out your risk profile. So, how to work out your risk profile. Date is a second. Okay. Your risk profile is a measure of how much risk you can take on and how willing you are to accept those risks. So, your risk profile is a measure of how much risk you can take on and how willing are you to accept those risks. A common misconception is that a risk profile is determined solely by age. Some schools of thought assume that the younger you are, the more comfortable you are taking higher risks, perhaps because you have more time to recoup any significant financial losses. Others claim that the older you are, the more experience and therefore confidence you would have when taking on risk. While age certainly can be a contributing factor, there are several other things that affect your risk profile. These include where you choose to invest your capital and how much of it you're willing to risk. So how much of it you're willing to lose, I guess you could say. How you handle money earmarked for retirement might be different from how you treat money set aside for trading activity. In this lesson, we'll explore 3 risk profiles and why it's important to know which you belong to. So, the importance of risk profiles. Knowing your risk profile could help you determine how you assess the markets, from the products you trade to the stocks you invest in, everything in between. So knowing your risk profile could help you determine how you access the markets from the products you trade to the stocks you invest in and everything in between. Consider your financial goal. Do you want to save up to renovate your family home? Are you looking to make a little extra spending money before a big vacation? With that in mind, let's look at the 3 ways you can make money from the market and which risk profile they may suit best. Consider your financial goal. Consider your financial goal when choosing your risk profile. With that in mind, let's look at 3 ways you can make money from the market and which risk profile they may suit best. Interest. Low risk. Interest is commonly associated with savings accounts but can also be earned on mutual funds, bonds, and you could even earn interest on cash not yet earmarked for investment in some brokerage accounts. You can contact local banks or look online to discover what options are available to you. Earning money through interest is considered stable and more predictable, whether your rate is fixed, compounded, or linked to inflation. The appeal is that you know upfront what interest you can expect to earn in your savings or investment, and there's less likelihood of losing your entire capital. Earning interest on an investment carries very little risk. However, should inflation rise above your interest rate, the value of your investment will steadily lose buying power over time. Interest. Low risk. Commonly associated with savings account but can also be earned on mutual funds, bonds, and you can even earn interest on cash not yet earmarked for investment in some brokerage accounts. You can contact local banks or look online to discover what options are available to you. Yep. Earning money through interest is considered stable and more predictable. Earning money through interest is often considered stable and more predictable. Stable and more predictable. Whether your rate is fixed, compounded, or linked to inflation. The appeal is that you'll know upfront what interest you can expect to earn your savings or investment, and there's less likelihood of losing your entire capital. So, the appeal is that you'll know upfront what interest you can expect to earn on your savings or investment, and there's less likelihood of losing your entire capital, and there's less likelihood of you losing your entire capital. Earning interest on investment carries very little risk. However, should inflation rise above your should inflation rise above your interest rate, the value of investment will steadily lose buying power over time. The value of your investment will steadily lose buying power over time. So the same amount is basically going to be worth less in the future if and will inflation happens, because everything is going to be priced more. So yeah, because if the money isn't increasing fast enough to be, if the money isn't increasing faster than in inflation rate, then what you can buy today you might not be able to afford, I don't know, in the future. I think that's what that means, losing buying power over time. Dividends. Medium risk. Dividends are a portion of a company's profits that gets returned to shareholders. Portion of a company's profits that gets returned to shareholders. In an ideal world, you'll be able to invest in companies that issue dividends that increase above inflation every year. However, dividends are issued at the company's discretion and are often tied to the company's quarterly performance. That means they can be reduced or not paid out at all. So, dividends are issued at the company's discretion, meaning they get to choose whether it's even going to be released or not, and they don't have to release it. So at the company's discretion, and are often tied to the company's quarterly performance, meaning they can be reduced or not paid at all. Dividends are also linked to an institution's share price. This is because when a company announces a surprise dividend, the share price can sometimes rise because there's more demand for the shares. However, it could also fall as demand can sometimes decrease following a payout. This means your initial capital can decrease in value even when you receive dividends. However, it can also fall as the demand can sometimes decrease following a payout. So it could decrease maybe because now that people got the dividends, they don't need the shares anymore, right? So they can just sell it off. Is that something that could happen? So dividends are also linked to an institution's share price. So when a company announces a surprise dividend, the share price can sometimes rise because there's more demand for the shares. However, it could also fall as demand can sometimes decrease following a payout. It could also fall as demand can sometimes decrease following a payout. This means your initial capital can decrease in value even when you receive dividends. Your return is potentially better than when you're earning interest. Potentially better, but the investment is riskier. There's no guarantee that a company you've invested in will pay dividends. You may also experience a capital loss depending on the company's performance. This means investing for dividend income is considered medium risk. Price movement. When you buy an asset like a share, you're hoping that you can sell it later at a higher price than you paid. This is investing for price movement. So, buying an asset and hoping it will rise in value later, then selling it for a higher price than you paid for it. This is investing for price movement. To take advantage of this, you need to purchase the asset itself or use a leveraged product to take a position on the underlying markets. When you buy an asset that's increasing in value, you make a profit. However, there are no guarantees that the asset you choose will appreciate. When an asset you're investing in decreases in value, you lose money. With the benefit of time, you could withstand that loss. If you open a leverage position in the market, you could buy or short sell different financial instruments such as CFDs or spread bets. Investing with the aim of taking advantage of price movements is considered a high-risk strategy. Taking leverage positions into the market takes it to the next level and is one of the biggest risks you can take with your money. Whichever you choose is likely closely tied to how much time you have and which product you choose. It's possible to use a blend of interest, dividends, and price movement. An exchange-traded fund ETF with bonds or cash as its base could work very well. You might want to choose one with some shares that give you access to both dividends and price movements. However, there's no guarantee that the asset you choose will rise in value. When an asset you invested in decreases in value, you lose money. With the benefits of time, you could withstand that loss. If you open a leverage position in the market, you could buy or short sell different financial instruments such as CFDs, contract for differences, or spread bets. Investing with the aim of taking advantage of price movements is considered a high strategy. Taking leverage positions in the market takes it to the next level and is one of the biggest risks you can take with your money. Taking leveraged positions in the market is one of the biggest risks you can take with your money. Whichever you choose is likely closely tied to how much time you have and which product you choose. Whichever you choose is likely closely tied to how much time you have and which product you choose. It's possible to use a blend of interest, dividends, and price movements. So it's possible to use a blend of interest, dividends, and price movement. An exchange-traded fund, ETF with bonds or cash as its base could work very well. You might want to choose one with some shares that give you access to both dividends and price movements. If you're an investor who prefers to focus more on price movements, your time horizon could stretch into decades. Here you can invest in shares to generate profit over time. You can also receive dividends along the way. By contrast, traders interested in price movements can have investment horizons as short as a few seconds. As you can see, risk isn't always just about how much time you have. A short few seconds. So if you're interested, or if you prefer to invest more on price movement, then you can either go really long or really short. Oh no, not really long, really short, as in like what is it? Your time frame can either be really long or really short. Risk isn't just always about how much time you have. Did you know, does the thought of losing even just a small portion of your investment seem intolerable or painful? You may be risk averse. Wait, does the thought of losing even just a small portion of your investment seems intolerable or painful? You may be risk averse. This means that you're not as comfortable taking on higher risk, even if it could result in greater rewards. If this is the case, you might want to stick to mostly lower risk products and focus on earning interest. You could try some medium risk activities such as investing in shares to potentially profit off dividends and selling some or all of your holdings when the stock's price rises. However, there's still the risk that the stock price could fall and that dividends might not be paid out. If you're risk averse, you may want to avoid leveraged products until you're better equipped to handle the associated risks. Risk averse. A risk profile for every need. Why do I keep clicking my right mouse button? You may have noticed that any one person could have many different risk profiles at once based on their goals. So you can have many different risk profiles at once based on your goal. Based on your goals. A retiree may have some money they don't need for another decade or two. They could also venture into high-risk territory with a leveraged trading strategy or in an individual share portfolio, all while keeping a portion of their capital in a high-interest savings account. Combining risk profiles will be dedicated by what you need or different investments to do. Combining risk profiles will be dedicated by what you need your different investments to do. So combining risk profiles will be dedicated by what you need your different investments do. Homework. One way you can check if you're in the right risk profile is to take a sleep test. Ask yourself the following questions. Does closing your trading platform for the day make you feel anxious or like you're missing out? Does closing your trading platform for the day make you feel anxious or like you're missing out? So you're missing out on some opportunities. Do you feel threatened whenever the market moves against you? Do you struggle to sleep when you hold positions overnight? Have you ever woke up in the middle of the night just to check on a chart? If you answer yes to any of the above questions, it might be time to rethink your strategy. When your investments or trades keep you awake at night, you're probably in the wrong risk profile. Often it means you've taken on more risk than you can afford. You can reduce your risk by closing some leverage trades and sticking to products within a lower risk profile. When your investments or trades keep you awake at night, you're probably using the wrong risk profile. It often means you're taking on more risk than you can handle. Low, medium, and high risk profiles. Your individual risk profile is an important part of how you interact with the markets. It's also unique to you, which means you should determine which one matches your circumstances. While you may fall into more than one profile at any given time, your profiles themselves may include a combination of higher and lower risk financial instruments. Generally, these profiles fall into three main categories: low risk, medium risk, and high risk. Let's dive into different profiles and how you might participate in the market within each. Low risk. So, low risk profile. So how different risk profiles participate in the market. Let's dive into different profiles and how you might participate in the market within each. Yep. A low risk profile is generally going to consist of savings products and bonds. Generally going to consist of savings products and bonds. Did you know when a government, bank or corporation wants to raise money, they may issue a bond? This is a type of security that acts as a loan for the issuer and investment for you, the purchaser. The issuer promises to return your initial capital in full at the date of maturity. This is just the agreed upon length of time until you'll be paid out. Bonds typically pay your interest on your investment annually in the form of a coupon. This is the term used for the type of interest you earn on a bond. Sometimes you can even convert your bond into shares after it's matured. Government, bank or corporation wants to raise money. An asset which acts as a loan for the issuer and an investment for you, the purchaser. So the issuer promises to return your initial investments in full at the date of maturity. This is just the agreed upon length of time until you'll be paid out, which is the agreed upon length of time until you'll be paid out. Bonds typically pay interest on your investment annually in the form of a coupon. Bonds typically pay you interest in your investment annually in the form of a coupon. This is a term used for the type of interest you earn on a bond, which is the interest you earn on your bond. Sometimes you can even convert your bond to shares after it's matured. By investing in a bond, you're loaning money to the issuing institution, essentially purchasing their debt. Should you choose to make this part of your wealth building strategy, remember that they don't always pay out in full. They don't always pay out in full. There's a chance that only a percentage of your initial investment will be returned. However, you'll often earn a higher interest rate than if you just put the money into savings accounts. Only a percentage of your initial investment will be returned. How high is that percentage though? If it's like they're only going to pay back 50% of what my initial investment is, then yeah, I don't really know. Remember that the issuer don't always pay out in full. There's a chance that only a percentage of your initial investment will be returned. However, you'll often earn a higher interest rate than if you just put the money into savings accounts. However, you'll often earn a higher interest rate than if you just put the money in a savings account. So this is where I think to get the most out of this, because for a savings account you would know how much interest you get beforehand, so you would know what end value you'll get after the savings period has ended, so you would know what the final sum or the final output from a savings account. But for a, what do they call it, bond? Yeah, for a bond, if you're investing in a bond, you would need to, since you don't always pay out in full, but they do issue a higher interest rate, you need to find out, because I think they do give you an interest rate beforehand, don't they? So you need to find out how much of the end, so when they pay you back your initial investment amount, how much of that you can afford to lose for you to be able to, I guess, break even or make more than your savings account, because you know the interest rate. So yeah, so for example, let's say you got like a 10 grand capital, you put it into a, I don't know, 5% savings account. By the end of that, for 1 year, you would know how much you're getting out of that. But if you're doing it for a government bond, investing in a government bond, for example, you still got your 10 grand initial investing capital. You put it in with an interest rate of 10%. You could then use the end value you calculated from your savings account and work out how much of the initial investment you could get back in order for you to benefit or make a loss. Yeah, that makes sense. Yeah. Savings products pay predictable and regular interest that can either be reinvested or spent. Depending on the need, while they may be low risk, your money could devalue. For example, say you have a savings account with a fixed interest rate of 3% per annum and inflation is at 5% in any given year. The cash in that account will buy you 2% less at the end of the year, even with the interest earned. Using low risk strategies like these also tends to make a profit slower than if you purchase individual shares or trade using leverage products. However, remember that savings account. Remember that money invested in a savings account could devalue. Profits made are also slower. Let's check your understanding. Say you're saving for the down payment of a new car. You sold your old one, you need to buy a new vehicle by next year so you can get to and from work without relying on public transport. You choose to place your money in a savings account with your local bank. They offer 2% per annum interest rate, and you choose to add £15,000 to your account. The cost of the new car you're planning to buy is £15,800. If you withdraw your funds after a year, will you be able to afford the car of your choice? So what's 15% times by 0.02? So 15,000, 3 times by 0.02 plus 15,000, so that's 15,300. No. First you need to calculate your interest, so 2% of 15,000, which equals 300, then add your interest to original investment. If you combine £300 and £15,000, your available funds equals to 15,300. This is £500 less than your ideal car's cost, so you need to postpone purchasing your car. Medium risk. Here we're moving up the risk curve. A portfolio for a medium risk profile could include individual shares or even collective investments like ETFs, investment portfolios, and interest-bearing products. So it could include individual shares, collective investments like ETFs, investment portfolios, and interest-bearing products. Some people use a mix of both low-risk products and high-risk shares, essentially creating a medium risk profile. You might start with 80% in a savings account, only 20% in shares, changing that ratio as you being comfortable with taking on more risk. Some investors use a mixture of high-risk shares with low-risk savings to create a medium risk profile. Question: you've just received a sum of money from inheritance. You're looking for ways you can try to grow it in the markets. You decide to put some aside for a special holiday you want to go on in the next 2 years. You're willing to postpone the trip if necessary to take advantage of higher returns. Because of your longer, more flexible timeline, you can take on some risk. Which of the following financial products would suit your profile? Leveraged products, an investment portfolio including shares and bonds. I think only not leveraged products, right? Yeah. This profile typically falls into the medium risk category. In this instance, you'll most likely select an investment portfolio that includes a mix of low, medium, high risk bonds and shares. While you do have time on your side, your investments may be volatile and devalue instead. The bonds in your portfolio could help reduce some of that volatility. Again, these products don't guarantee a profit, and the issuer may be unable to return your full investment. Higher risk. In high risk profile, you might want to trade products with higher liquidity. So trade products with higher liquidity, as well as build an investment portfolio. As well as build an investment portfolio. You could also add derivative products such as CFDs and other leverage products. Could also add derivative products such as CFDs and other leveraged products. The money you set aside for a high risk portfolio should always be money you can afford to lose. The money used in a high risk portfolio should always be money you can afford to lose. This is because the markets can be volatile and there's always the risk that you lose some or all of your capital. As the markets can be volatile. There are also different charges involved in these leverage products, which may eat into any profits you make. There are also different charges involved in the leveraged products, which can eat into your profits. Here's a handy way you can manage how much money you need to use. You need to use different high-risk financial instruments. Homework. Use the table below to investigate different leverage products, how they work and what they cost. Complete the details about each investment. The first one has been done for you. CFDs. How does it work? A leverage product used to speculate on the underlying market's price movements. You take a position based on whether you think the price will rise or fall. Some CFDs will have a spread wrapped around their buy and sell prices, whilst others will incur the commission. What extra costs may apply? Live price data fees for certain shares, currency conversion charges, overnight funding charges. Here's a handy way you can manage how much money you use different. Remember, some leverage products like spread bets and CFDs could see you losing more than your initial outlay, so you need to prepare for that financial drawdown as well. Some leveraged products could see you losing more than your initial outlay, so initial investment. So you need to prepare for that financial drawdown as well. So you'll need to prepare for that financial drawdown as well. So drawdown, remember, is the losing streak that you're going to inevitably get. By maintaining a solid understanding of which profile or profiles your wealth building activities fall into, you'll be able to better understand your risk appetite and therefore which products are right for you. Yep, okay, so let's just summary. Your risk profile is determined by your financial goals and risk appetite, not just by your age. Your risk profile is determined by your financial goals and risk appetite, not just by your age. There are three main risk profiles you might fall into: low, medium, high. Depending on which risk profile you fall into, you may focus on earning interest and dividends or try to make a profit from price movements in the market. If the thought of losing even a small amount of your money in the markets cause you discomfort, you may be risk averse. Remember, risk averse is not as comfortable taking on higher risk, even if it could result in greater rewards. So in that case, you might want to stick to mostly lower risk products and focus on earning interest. Cool. Okay. Wow, that was a long lesson. That's the whole of this video, but okay. So I guess I'm going to leave this episode here then. So in the next video, we're gonna move on to understanding leverage. So thank you all for watching. Bye bye.